Welcome back to The Hurdle Rate, episode 25. I'm Tim Kotzman. I'm here with Jeff Walton, Ben Workman, and Matt Cole. And we have a lot, as Jeff said right before we started recording, we have a lot to cover today. A few of the topics we may cover include Fed independence, job weakness, and what happened at Bitcoin Asia. So maybe throw it over to Jeff or Matt. Both of you were over at the conference. What was the vibe?
Well, first, I think it was both of our first times in Hong Kong, and what a beautiful city. It was absolutely beautiful city. If you have a chance to go and you haven't been, highly recommend it. As far as the conference, it was a lot of people. It ended up being about 20,000 people, and I think for reference, the Bitcoin Vegas conference was around 30,000 people. And so these are massive sporting event type style conferences. And it really helps set the perspective of the global phenomenon that is Bitcoin. I mean, Jeff and I on the second day were two of the last four slots on the main stage. And so Jeff had an awesome keynote presentation on digital risk. And then I was on a Bitcoin Treasury panel right before Eric Trump closed it down. And I mean, it was people as far as you could see, and just kind of some of the context. I mean, it was English speaking, a lot of bullishness around Bitcoin, a lot of interest. And I think Jeff had an interesting observation of in the kind of more VIP area, Eric Trump was speaking. And didn't you say that there were people with literally their ears up to the wall trying to hear any form of alpha that they might hear on the VIP conversation?
Mm-hmm. Yeah, they had their ears on the wall. Once Eric Trump did get on stage, it was like a rock star got up on stage. Everybody took out their cameras and was taking pictures. It was like it was totally insane. A little bit more on statistics too. I think the prior year Bitcoin Asia was around 4,000 people, and this year is around 20,000. So it's 5x year over year.
Wow.
Hong Kong is just a crazy city. I think it's one of the most densely populated cities on the planet. You get off the plane, and there are just condo buildings, apartment buildings everywhere, but it's still surprisingly clean compared to other big dense cities that I've been to. So it was a amazing experience. I also, to your point, Matt, everybody spoke English, so you could communicate really well. There wasn't really a language barrier anywhere that I really ran into, which was pretty interesting. But yeah, a lot of excitement, a lot of bullishness, just from Asian markets themselves. I know there are quite a few corporations that are starting to lean into thinking about adding this asset to their balance sheet, and that's starting to move forward a little bit more. There are some more regulations and different capital environments that need to be taken into consideration, right? Like I think Chinese stock market, they don't have the infrastructure for issuing ATMs. So if companies do want to raise equity capital, they've got to do it in a different way. So they've got to think about things a little bit differently. And there are different rules and regulations in each one of these different capital markets. So, private companies and public companies are thinking through the logistics of what it would take. And this stuff just takes time. It's not I'm going to add Bitcoin to my balance sheet and start, raising equity capital tomorrow or issue a preferred stock. Like, it takes a significant amount of time for these things to come to fruition. So anybody that's been putting in energy for the last 12 months actually has a 12-month moat over anybody that's starting today. So just to put it in perspective.
What were the most interesting questions or conversations you were hearing? I mean, obviously it's a very different environment than it was in Vegas. You might have had a lot of overlap in terms of a lot of the people and the speakers that were showing up to this one, but what did you find the most interesting or the most different about the conversation happening in Hong Kong versus Vegas?
I've got some perspective on that. The general theme and takeaway is that Asia is 2 years behind on everything that people have been doing in the US. I mean, obviously, MetaPlanet is pretty right behind strategy in terms of where they're going in this marketplace of, issuing debt capital, issuing equity capital, and doing it in a wrapper in a country. But like the rest of the Asian markets are just a couple years behind. I think that's the general theme. There's a lot of just really basic education happening. And I don't know if that was just a function of the speakers and what they chose to speak about, or if it was actually, what the market needed or what the marketplace needs at that point in time. But some of the commentary I've and feedback I've heard is that the Asian market is just 2 years behind where the US market is.
And is that more from a regulatory perspective that they're catching up and trying to gather clarity, or is it just that they're behind on the Bitcoin trend in general?
I think a little bit behind on the Bitcoin trend in general. And some of the other feedback I got from a few other conversations I had were in Asian markets, they don't use Twitter as their alpha. Like they use this app called I think it's called the Little Red Book, which is like TikTok and Twitter had a baby, and it's all in it's in Asian and Chinese and different languages and things. And apparently there's a lot of meme coin and altcoin conversations that are coming up on that platform and not necessarily focused on Bitcoin. Like this guy pulled it up and showed it to me. And the first 3 posts were like Ethereum, Tom Lee, and then like meme coin. And like we scrolled until we saw Bitcoin, and it wasn't like for a little while. So I think that they're looking for the next best thing as opposed to the best thing.
Yeah, that was my observation as well. And it wasn't even like necessarily, I mean, I agree with the trend on, in some ways being a couple of years behind, but it was more that there was a lot more focus on other coins other than Bitcoin. They're not necessarily on stage, although I did have an interesting dynamic on my panel where I had to shut down someone who said that besides strategy, that Tom Lee and the Ethereum Treasury was the only other thing that got him excited in Treasury space. And so anyways, I wasn't planning on having a debate on stage at the Bitcoin conference right before Eric Trump went up, but I had to say my piece on that. But more in the broader audience, the focal point on more altcoins. And I think to Jeff's point, it's because of what they see and what they're exposed to. So that was one dynamic of people. The other dynamic was people in international markets, whether it's Asia, whether it's Hong Kong, whether it's Japan, whether it's Australia, that were following specifically like what we're doing. And we're so like that there really is an international following. So I think it's bifurcated, that there are people in these markets that are following what's going on in the US very closely. And there are people that are in more of their own, ecosystem of what they're exposed to. And I think those people are much more likely to not be buying Bitcoin, just probably because they're not seeing the best arguments for that relative to whatever new coin that probably has a cheaper price than Bitcoin.
And what was the feeling from the investors that were at this one? So obviously Vegas was a huge gathering spot for all the investors and the banks, and I would assume that Hong Kong drew in a very similar crowd. But given that we've had this kind of extended drawback in the Treasury space, what were the conversations like with the investors that were at this one?
So interesting with like the bankers and the larger investors, and it's kind of unfortunate actually, is that I think that they're just more focused on wherever the hot treasury company is and less on Bitcoin specifically. It's been an interesting just kind of learning of how, and it kind of makes sense that Wall Street has been so slow to adopt Bitcoin that they never got it to begin with. And now that they're coming in, it's also just a trade. It's an investment. It's not a thesis. And so I think that's why there's still a lot of opportunity in this space, that I think a lot of people are frankly just lost of how to think about value other than, hey, well, I even had a call with, an investor, on the current cap table with Strive that will remain nameless. And they're like, why'd you choose Bitcoin? Like, you could have chosen another coin and it could have popped. I mean, you're kind of late to the game behind strategy. And it's like, and then I explained to him how there's differentiation, how we can differentiate. And he's like, well, that makes sense. But like, you still could have chose, another coin and it probably would have popped, 300%. And it's just like, you don't understand the dynamics of a perpetual trade that we're trying to make on long-term debasement of fiat currencies, perpetually long Bitcoin, short dollar. Anyways, I think there's a lot of confusion and that never ceases to kind of surprise me, just because I think, we kind of live in our own echo chamber of understanding the long-term dynamics of Bitcoin. But I think where that leaves me is, as much as, I still believe just as much that altcoin treasury companies are built on houses of sand, that a thesis that houses can be built on sand, they just don't last. And that there might be, on the short-term dynamics, some more wind behind some of these name-year altcoin treasury strategy, just given the large amount of money that has no idea what they're doing in the space.
I'd also just to hit on that in terms of scale, to put this in perspective to Vegas, the whale space in Vegas was probably 8 times larger than the whale space in Hong Kong. And the institutional area, like the Bitcoin for corporations area, maybe had 100 people that were sitting in the crowd, maybe. So in terms of the scale, significantly larger corporate focus and like banker investor focus, whereas this felt a lot more retail focused, and maybe there were institutions there that were just curious, but we weren't seeing a lot of like, sit down, get deals done types of conversations. I'm sure they're happening outside, but it wasn't necessarily like as apparent as it was in the institutional space in Vegas.
Yeah. And other than your keynote, Jeff, what was the other one that the audience seemed to really gravitate towards? What did they really like there? Obviously, you got to imagine MetaPlanet's a hometown hero around that area, so I got to imagine that anything they did was big. But what else was there?
Well, that's what you missed. That they went there. They were key sponsor. Their name was everywhere.
They went quiet, right?
In a blackout period, right when they got there, and so they had to cancel all their appearances. And so, anyways, Dylan and Simon,
even keynotes and stuff.
Yeah, even keynotes. So Dylan and Simon were in the same hotel as Jeff and I. So we ran into them, chatted with them every day. They were just hanging out at the hotel the whole time. But then obviously you saw their shareholder meeting kind of go through. But I can only take that to mean that they have something big in the works when they are the key sponsor of a hometown, Asia, Bitcoin Asia, and their stuff in the hotel the whole couple days.
Oh, what a bummer.
Yeah, Matt, what you were saying a minute ago about catching up and explaining, I view it as catching up when you're explaining to someone on the cap table why Bitcoin is differentiated from other coins. It just a little bit reminds me of Saylor saying, right, 5 years ago, he's like, I couldn't sleep at night because I thought someone else is going to figure this out before I get enough Bitcoin. And it's like, we're still, right, the process continues until the education curve, I guess, goes up, right? The S curve.
Well, we're still in the gold rush period for sure, right? I mean, it's interesting because it definitely sways, the market sentiment sways heavily. And it does feel like over the past several weeks, you've probably had some institutional capital withdrawing from the area, and whether it's rotating into other areas or it just, saw that there was some weakness in the space and decided to start pulling out of it. Sentiment really dropped off a cliff recently. And you're seeing it kind of across the board in the sector, and people are abandoning that even having a significant balance sheet of Bitcoin is a good thing. And now they're trying to tell you to sell the Bitcoin and move on to other things. And I think that that's something that's not unusual to Bitcoin, right? We go in these cycles. And I will say one of the things that I've noticed as this has moved away from, Bitcoin, the spot asset, and more into the equity space, is that it seems to have reconditioned a lot of investors back towards short-term timeframes.
Short-termism.
Yeah. There's a heavy bias towards the, what have you done this week, right? What's happened this week? And I think that the long-term thesis, kind of falls to the side, and investors lose faith in the thesis, and then, Bitcoin goes on a run and it comes back and premiums expand and people are back in the space. But I think we're definitely in one of those lulls at the moment. But I still think that these are the time periods where companies still need to be accumulating Bitcoin, right? You're preparing for a future, right? You're in a perpetual trade against the debasement of the dollar. So constantly accumulating Bitcoin is always going to be the right choice right now. And you look at Jeff and Matt, and they've got to be just downright giddy, hoping that Bitcoin, comes down below 100,000 before, they get through their merger and everyone goes out and votes yes on the merger so that they can, get their money and go start buying. There's probably nobody happier to see a drawdown right now than them. But it's one of those things where it certainly shakes confidence in the retail market, and you have to kind of re-entrench around the thesis and understand how long-term of an investment strategy this really is, right? This isn't something that's won overnight. And Strategy didn't build up their size and scale in 1 month, 6 months, 1 year, 2 years, right? They're 5 years in. MetaPlanet's well over a year in. So these are slow and steady races that you're fighting for position in, and you're kind of racing against the speed up in the debasement of the dollar, right? That's kind of what you're doing right now. And so I think while it's tough, and when your accounts are down, it's always hard to remember what the long-term thesis actually is when a trade isn't going the right direction for you. But you just got to re-ingrain and remember what the whole point of this strategy was to begin with, and understand that just like Bitcoin, this is a long-term thesis. This is not a short-term trade.
4 year. It's a 4 year hold. You look at every 4 year compound annual growth rate period of Bitcoin's history. If you turn it into a duration asset, you're positive. Like the 99th percentile of 4 year compound annual growth periods, if you were to buy it and sell it every 4 years, 99th percentile is like 22% compound annual growth rate, which is just blows everything else out of the water. So if you start to reframe your mind of like, okay, well, I got Bitcoin as a 4 year asset, any Bitcoin treasury company is a 4 year asset. If I take a position thinking about it as a duration period, it greatly increases your probability of success. If you don't hold for a 4 year period, your probability of success drops pretty drastically if you look at just the general volatility and buying peaks and troughs, et cetera. But not everybody's made for this world and the long-term conviction. You can't rent your conviction, as you say all the time, Ben. You've got to own your conviction and build it yourself. And I mean, there was another topic I wanted to talk about, which is Anthropic. To your point, Ben, of money flying everywhere, Anthropic did a $13 billion capital raise at $180 billion valuation. I think that closed today. Just wild to see the scale of some of these capital raises in this space. And I don't know about you guys, but it seems to me like this AI is going to be frothy, right? There's a lot of capital flowing into a bunch of these different AI projects. And there's going to be a few winners, but there's going to be losers too. And so the question is, who's the winner? Who's the loser? It seems like there is sort of a AI type bubble forming. And I don't know if it's going to be the size and scale of .com bubble, but maybe it is. And I was just this weekend doing a little bit of history and analysis on who succeeded after a .com bubble. And it was basically anybody that had a strong balance sheet, because you were able to eat up any of these other .com companies and take advantage of things in a distressed marketplace. And if you're any type of non-AI company and you're subject to AI type market crash or conditions, you better have a strong balance sheet to be in position to take advantage of what the future may be. And I think these companies that are adopting, Bitcoin Treasury or cash reserves will be in a very strong position moving forward.
Well, it's interesting to contrast the two, right? So when you look at the Bitcoin treasury space, right, where these companies are focusing on building that permanent capital base on the balance sheet, and then you look at AI, AI, you have a lot more winners and total loss outcomes over there, right? Because you're dealing with the pace of innovation and who's out innovating who. And if you take too long to get your product to market and build the user base, you may be overtaken by one of the other AI platforms. And I think it's going to be a really competitive area. But those areas tend to have, exactly like you said, those frothy periods, right? Where the imagination's running wild and you're looking at all these smaller AI startups and you're going, what if one of them is the next Anthropic or the next, ChatGPT or the next, name your AI tool. And so you're going to have a lot of speculative capital flying around there, and it's going to be moving fast. And as soon as, the bigger players that are really deep in that space start to sense weakness in one of the companies, they're going to pull out of that, move to another one. And I think you're going to see a lot of, rapid falls. Whereas the companies that are building through their balance sheets, exuberance can come out of the market, but you're still on the foundation of Bitcoin, right? The balance sheet is still intact. And so you've still got that permanent capital position that's out there. Whereas with a lot of these other AI plays, I think that you've got a lot more risk to the downside in those plays, just because you're dealing with innovation and something replacing your entire product platform, which is what can result in these total losses. So it is going to be interesting to watch capital flow around, because it's clear that the AI space is going to attract a ton of capital. And part of that is you're still trying to see, what's really possible and what's vaporware right now, right? There's a
Yeah.
ton of marketing going into the AI space, and it's powerful. And I think we all know it because we use it constantly, right? It's totally revolutionized the way you get information. I don't know the last time I've done a Google search. No idea. Because the AI tools are so much more efficient and they can bring you several sources that you can go look at on your own, right? I mean, it's definitely changed that. So the speed to information, but that's just the tip of the iceberg, I think. But we don't really know, right? We don't know what this is going to look like in 2, 3, 5 years. And so people are still in that imagination phase where you're trying to figure out exactly what scale of opportunity am I dealing with here and which areas have real opportunity for disruption versus which ones make for really great marketing talk points. And we're going to find the answer to that. We're going to find it probably in the next, 24 months. And it's going to go fast, but the capital is also going to move fast in the space. So you just have to be aware.
And for better or worse, I feel like what you just said over the past 60 seconds, Ben, you could also apply to Bitcoin Treasury companies, right? We're in the beginning. We don't know where this is going. I mean, there's a lot of stuff still on the desk at the SEC that we hope is going to be approved over the next 6 to 8 weeks. I mean, there's just, right? I think a lot of people assume, we got a new flag in Washington, everything's going to be great. And it is, but there's a lot of work to do. Maybe just leave it at that. STRC, Jeff, or whoever wants to take it. Why did it get increased from 9% to 10%? I think a lot of people that are maybe just like seeing it fly across their radar, but they're not really paying attention. They're like, what is STRC and why did it go to 10%?
Yeah, I could take it. So it's effectively a variable rate perpetual preferred equity meant to be a stable coin. So the goal is to peg the value of STRC between $99 and $101. So if the price of the perpetual preferred equity is below $99, then they have the ability to increase the rate such that it attracts more capital to come in the door. So the price gets driven up into the zone, between 99 and 101. And once it's in that zone, then in order to keep it in that zone, they'll increase the interest rate if the price is below, or they'll issue more equity into the market if the price is higher. So given that this is the first dividend that's been paid out, I think it should have gone out today. It was effective on Sunday, but I think it's T+1 from business trading day. So it should hit accounts either today or tomorrow.
It came today.
Nice. I haven't looked yet.
The mailbox.
So yeah, it should hit today. And so that's Tuesday. Yeah. So I think that we're in this period where they're adjusting the interest rate in order to get the price back up to that zone.
But to me, what it shows is they're going to be aggressive with getting it to that $100, right? They didn't have to do a full 1% raise going from 9 to 10. Right, they could have tried a 25 basis point or 50 basis point increase in order to try to get it there. What it says to me is this initial push, they're going to be pretty aggressive with trying to get that to the par value, to that $100 value. So we'll see. It didn't immediately jump on that news, right? We're still in that mid $97 range, so it didn't, drive it up yet. So we'll see what happens here throughout the month. And this month in particular is going to be interesting because now investors, because this is the month where all of the dividends hit, you're going to see people positioning across the different products, right? You got the ex-dividend date on the 15th. And so people are going to be doing that analysis, trying to maximize. And with STRC, you're in kind of an interesting spot because you're weighing, the heftier dividend, right? STRD is paying out a little over $3 a share because it's effectively 4 months because of when the IPO happened. And so people now with STRC are going to be weighing, is it worth it? If the capital gets high enough, if it gets above 98, then do you rotate that to STRD for the ex-dividend date to capture? So I think there's going to be a lot of capital movement among those preferreds because people are going to try to maximize what they're getting from the dividend payments here at the end of the month because this is the quarterly one where all 4 of the products are paying at the same time. So I'll be interested to see how the prices on these all behave coming into the end of the month.
I think there's still a lot to be written on the ability of STRC to be stable. I mean, you think about it, it was just recently that they did their IPO, and it was a massive IPO, and they priced it substantially lower than the current price. So even though we're not at par yet, you have a ton of investors that have gains, right? And so there might be some working through of that. I think it will remain to be seen, but I think what will not remain to be seen, maybe to be educated, is the credit quality of these instruments. And Jeff and I spent a good amount of time in Hong Kong just kind of talking through the credit quality. And this will be a topic for another day that we're going to go deep in. But the TLDR is strategy should be considered AAA debt. And I think oftentimes we've talked about investment grade debt. But when you actually look at some of the metrics that we're going to talk about, it's AAA. And when you start thinking about AAA debt at a 10%, it's actually above 10% because at a discount, above 10% effective yield for something like STRC, that is a extremely attractive instrument for the credit quality of it. And I think that people are still trying to get their hands around how to evaluate the credit risk. And, in our bubble, we might think of it as, I've heard investment grade thrown around a lot, but if it's AAA, then what should the actual spread be to US Treasuries? 100 basis points, maybe. And so you're talking about something that could be priced down to, a 5.5% range. It probably takes years to get there, would be my guess. But during those years, you could clip a lot of coupons and high coupons, and then have that spread compress as people actually understand the credit quality that they have there on their balance sheet. And so I think the one thing remains is the stability of the instrument, tying an underlying volatile asset to a stable valuation. But that doesn't change the credit quality. All it changes is, does the price move in 2-3 point instruments, or can they constrain it within the 99 to 101? And I guess is they'll be able to actually achieve that as the initial shares kind of work through. But I think that's to me the only open question of that instrument.
Matt, to some of our listeners that may not be aware, can you give us some examples of other AAA issuers in the market?
I will try. So at least on like the A plus rating, you would have like the Apples or Microsoft or Berkshire Hathaway, large companies that have extremely strong balance sheets that aren't over levered would be in that range. And they're typically almost like a sovereign in and of themselves, right? Corporations that have such a strong balance sheet, such a strong history of paying their liabilities. But when we were talking about this, and we will lay this out, there's two ways. So typically when you're valuing those companies, you're still not looking at their balance sheet. You're actually looking at the stability of their go forward cash flows to be able to meet those liabilities. And I think with regards to strategy, you think about the balance sheet and the difference in arbitrage opportunity of the go forward returns of Bitcoin relative to the cost of interest, that on either one of those metrics, it's something that we haven't seen, but those are the type of companies that you're looking at.
You got to reframe your thinking when you're looking at it at a balance sheet versus cash flow and future earnings potential. It's just a different framework to wrap your head around. And you hit on another really good thing there, Matt, which is that there's a lot of, within these instruments, like people have been yelling at the top of their lungs on X, why hasn't STRC hit 100 yet? And it's like they issued this product 5 weeks ago. There was a $2.5 billion capital raise, and there's this merger or this IPO arbitrage. So anybody that got it at, what was it priced at 85? Anybody that got it at 85 now has had the ability to sell it at 95, which, what is that, like a 12% return in 5 weeks, 15% return in 5 weeks. And if they had the ability to offload that, they're offloading that. So there's upwards of $2.5 billion of IPO capital that needs to turn over into different hands that wants to hold that instrument into the future. So that takes time. And it's very similar to how some of these Bitcoin treasury companies are operating with these pipes. You've got this merger arbitrage situation. And yeah, that's I think that's what we're working through right now, is getting to this, next stage of STRC.
Yeah, I think what the timing that's going to be interesting with STRC is going to be the first ex-dividend date when it's trading at 100. That's the one to me that's going to be interesting, because you get a lot of these IPO buyers where the messaging that's ingrained into your head is, we're going to peg this at 100. So you see it get up to 100, you go, okay, the capital appreciation's done. They're going to actively manage it to kind of keep it here. Maybe it bounces above it, but it's going to be coming back to 100. And so once you get to 100 and you get the dividend, a lot of these investors could effectively go back to cash and just come back for the ex-dividend date the next month, right? So I think you'll get some people that'll play that game, but I don't really care about the long term there. But what I'm interested in is the very first time, because I think what that's going to show is how much of that IPO capital is going to turn over, right? Are these people that are actually intending to hold this for that yield over the long period, or did they see an opportunity and they're trying to just hold it to get up to that $100 par value, collect some of the dividends along the way, and then they'll free up that capital again? I think that first one is going to be where you see how much turnover and how much downward pressure that puts on it. Are there buyers that are going to come in and swoop those up?
That's super interesting. It brings me back to my fixed income days. So fixed income instruments, they actually accrue interest underlying the price of the bond. And so when you're getting close to a payment of a dividend, let's say you pay par. When you actually go to settle the transaction, you have to pay par plus the accrued interest that accrued over that period. It's actually an additional part of the calculation of how much money has to change hands. Or to my knowledge, that the perpetual preferred instruments don't do that. And so that's where you get this X dividend opportunity that doesn't exist. You would think that over time, the markets would adjust to this and that they would have their own mechanism of accruing interest as you get closer to the dividend date that would then drop down. I don't know that we're there yet. I highly doubt that we're there yet, which is probably why, you get that ability to think about those trades and maybe at some point it actually goes the other way where they drop too much post dividend because you get too many people playing those trades. But there's, that's something that's actually done in a very seamless and sophisticated way in traditional fixed income markets. And I think with these, just given the size and kind of the new instruments for people there will be some learnings in kind of how that adjusts pre and post dividend.
Yeah, right now, I don't really view these through the institutional lens yet, because I still think that a huge part of the demand around these was retail. And so I try to think about, if you're in a retail investor's shoes, where would they be trading in and out of these? And it might be out of retirement accounts. So if I've got tax advantaged accounts where I'm not triggering taxes, I can effectively be in cash for all but 4 days out of the year and get S&P 500 returns. And so you start to wonder, are people going to play that game? And to your point, Matt, that's probably where that'll get solved, is if you start seeing those over sell-offs and you start seeing that capital loss, and then people realize, well, you just got to stick in it, right? Because that gets replaced when you're coming up on the other side, right? Will the market flush that out eventually? I think they will, right? I think to your point, the market will build in that mechanism to regulate that. But in the early days, I'm not so sure. So I think we've got some inefficiency that's probably going to happen here through the first several quarters of these. But it's going to be fascinating to see, as soon as the institutions do start really acquiring these products more. And I'll be watching those 13Fs over time to see who's really holding these over time. And is that institutional lowering or increasing over time? Just to see, when you have different participants in the market, the behaviors are going to be different. And those are much more sophisticated buyers than how retail is going to look at these. But I think right now there's probably a lot of retail demand around these products right now. So we'll see how it plays out. I mean, this is going to be a big quarter. You saw what happened with the last dividend payment. Things went a little nuts for a while afterwards, right? And I don't know if that was just low float and dividend reinvestments that were causing a lot of purchasing that drove those things way up or not. But I'm really curious for this next quarterly one to see if you have similar behaviors around these, or if it really stabilizes quite a bit.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private. Matt, did you want to hit on the Fed and what rates probably should do versus what we all think they will do or won't do, or right?
Yeah, well, let's do it. Let's do it. There's been a lot of chatter around Fed independence, around President Trump firing board governor Cook, and then the lawsuit of Cook, not leaving her post, and has the Fed lost its independence? And meanwhile, the market didn't really react at all. And so I think that's a fascinating divergence of mainstream media calling for the Fed losing its independence and the market just kind of shrugging it off. And so, what is actually going on underneath the hood there? I think what it is that the market already understands and has understood for years that the Fed is not independent. And so there was no independence to be lost. And I think that's kind of a core thesis of Bitcoiners and the belief of long-term fiat debasement. And we've talked about things like the printing of money and the Treasury issuing bonds, selling them to Goldman Sachs, and then the Fed buys them from Goldman Sachs, right? Versus just directly Treasury selling to the Fed. And that one step is why it's not printing of money, but it's considered actually an open market operation that's not printing money, right? But it makes no sense. Is that the reality is that the Fed hasn't been independent for years, and you look at who gets appointed to the Fed, and when Democrats are in, they put people that have Democratic views of how the Fed should operate, and Republicans are in, they do the opposite, and it's a political body already, and I think that's the bottom line. And so when you see something like this Fed governor be fired, I mean, well, first and foremost, if she did commit mortgage fraud, I mean, that's probably a fireable operation. I mean, we'll let the courts decide, but I think that's a pretty clear instance of if someone did that they probably should be fired. But regardless of if that stays or not, I think that the real story here is that clearly it's not just Bitcoiners. The whole market understands that the Fed is not an independent body. And so I think with that, no longer hiding, because I think before this incident, I think still in institutional circles, they would claim the Fed is an independent body. That would be something that you couldn't, as a CFA working at a large pension, speak, in the contrarian position to and have any credibility in the room. I think now that we're moving past that, we can actually start talking about, well, what should the function of the Fed be? And I think understanding, should they be setting interest rates? Should they be having a dual mandate? If there is a dual mandate, is one of the mandates more important than the other? All these different things you can start to unpack. And I think ultimately it should end up with less responsibilities in the hands of the Fed. The second part of the question about should rates be lowered, I think we're finally getting the answer is yes. But I think this kind of gets into part of the problem with the Fed that Secretary Besson has been calling out really well, actually, is that the difference of a businessman's mindset versus an academic's mindset. And if you think about the position of an academic at the Fed, they look at data, they look at core PCE, inflation, labor statistics that are being updated up and down, and inflation statistics that have all these adjustments to it that lag more real-time looking metrics like trueflation that we've talked about many times on the pod, that actually remove some of the biases that you look at trueflation. It showed what inflation was in COVID about a half a year before actual PCE showed up. And you had Americans saying, I'm seeing the prices rise everywhere. Why is inflation low? Well, it was because of all these adjustments that they had to put in, that they worked through. And so ultimately, I think when you start looking forward and you look at some of the AI pressures to come, and there was a study that came out that showed really some pretty strong weakness in jobs, particularly around jobs that were susceptible to AI risks, more entry-level jobs like software coders, customer service reps. It was a Stanford study that was in the WSJ, that there is underlying weakness there, and that inflation is not very high. And it was just pre-election that the Fed cut 50 basis points. We should be moving lower, and I think we are. And I'm in a sense happy to see that this debate has kind of shattered some of the untrue veneer that the Fed is actually an independent body.
I've got trueflation over the last since March under 2% for 95% of that time, as low as 1.2% in April.
So for those that maybe don't follow it, one of the most interesting differences between trueflation and common CPI is that common CPI actually does substitutions. And so let's say if the basket of goods included beef as an example, and beef skyrockets, they take beef out and they put chicken in. And so you don't see the inflation because they've literally changed what you buy. And the assumption is that Americans, when faced with something rising, will choose a cheaper good, and that cheaper good then becomes a cheaper good, probably becomes bugs eventually when chicken becomes too expensive. But the reality is that there's a lot of value in just seeing the price of a static set of goods that people would generally buy over time, and not assuming that people just degrade their purchases. And so that's what trueflation does. It holds the basket of goods constant. And I think that then shows a very different picture for what inflation actually looks like. It ends up showing higher inflation over time, number one, but it also shows more real-time metrics because you can't hide if your basket of goods is actually increasing in price.
Yeah, CPI for breakfast foods used to include eggs and bacon, and now I think it's only cereal, which is pretty crazy. And this was something I was starting to recognize in the insurance world as I was transacting reinsurance deals. We would go back and we'd try to as if claims into today's dollars. So we'd take old claims and trend them by inflation figures to get to today's dollars. But what I realized is that even if we trend some of these old claims in terms of size and scale, they weren't nearly as big as some of the events that were occurring. And we were trying to dig into what's happening here. And average claim size was rising pretty significantly. So it just became very apparent that a lot of the industry was using inflation figures that were just wrong. And if your inflation figures are wrong by 50 bips or 100 bips, that has a huge impact on how you calculate your downstream long tail liabilities and how you try to manage your asset portfolio to that tail of liabilities into the future. It just became very apparent. There's a big issue here, and I think there's going to be continued issues if these insurance companies cannot add the hedge that they need to their balance sheet in order to offset this debasement into the future. So there's a lot of opportunity for innovation on the balance sheet, whereas most of the insurance market was focused on the underwriting machine.
What do you think, Ben? Should rates go lower, or we gotta hold them steady for a little bit longer?
I think they're going to have to go lower. I think they're running out of options, and you're starting to see the cracks out there. Right now, you're starting to hear them talking about declaring a housing emergency, which goes back to one of the really early episodes we did, where I think it was Matt who said, when the average income can't afford the average house, you've got a real problem. And you're starting to see the signs of that. And I think you're starting to get to the point where if they want to keep fueling the economy, those rates are going to start coming down. And once they start coming down, I think they're going to be coming down for a while. So I'm just positioning and preparing with that as the main thesis, because if over time you've started to see the signaling, and I think that message is getting pretty loud now. So I think they're on their way.
All right. Well, hopefully it's Uptober and Rocktober and up November, whatever, or as Jeff just says, higher.
I don't know where it's going, but I know it's going higher.
You heard
a couple
it here.
weeks from now, I'll be joining the unapologetically go higher crowd.
Yeah, we would need a little time.
But right now, Matt wants everyone to know it's scary out there. Yeah. Maybe be risk off for a couple weeks.
And there you have it. A hurdle rate, episode 25. Thanks everybody for listening and watching. For Ben Workman, Jeff Walton, and Matt Cole, I'm Tim Kotzman. We'll see you next week.